and should pop up soon. All right, guys. I'm with Jordan Roy-Byrne. Hi, Jordan. It's always fun there to talk to you. So super happy there that you came on today.
Hey, thanks so much for having me. It's a real pleasure to be on with you. Looking forward to this.
And Jordan, I have a few questions there. If we could like just dive into it, because I was looking at a few charts, and then there's like this Harry Dent fellow there, and or the other Henrik dude. But I always try to be the like, let's say like, I know like I'm long term bullish, but I was looking at the gold chart, and I'm just trying to fit, like, let's say I'll remove all my drawings. I'm just trying to fit how the hell is it going to look like a move to 900? Like, I don't get it. I'm just trying to see how in the weight of evidence, let's say I have a 3-year moving average, or even like, it's tough for me to phantom, or maybe it's because I'm not looking at it like, how do you think they're figuring it out there, or did you ever go through that scenario yourself, saying, okay, let's see what type of roadmap could I have that could maybe bring me down to these upper, like these super low levels?
Well, I mean, the idea that we're going to have some massive deflationary crash is, I mean, I'd like to give people some history on that. I mean, Robert Prechter was talking about that. I think he had this book called Conquer the Crash. And it's actually a book that I read. And in the late 90s, I think his prediction was gold was going to come down to, I don't know, 175 or 150 or something like that. And and then everything would go up after this huge deflationary bust. I know Martin Armstrong has like a cult following. And he had, I think in the late 90s, he had the same opinion. I mean, his followers will tell you, no, he didn't. But I think I was reading, I think he had the same opinion. So like this view has been around for decades. And I mean, these guys who have that view, and aside from Prechter, because Prechter won some kind of a trading championship in the US in the 1980s. So he's actually a really brilliant guy. He called the bull market like in 1981 or 82, and he said this is like the start of a huge bull market when stocks broke out. So he's a legitimate analyst. He's a legitimate market analyst. But he got, I think, too wrapped up in Elliott wave theory, which is subjective. I'm not a fan of subjective analysis. So he got too wrapped up in that, which was calling for this massive crash. Another thing about Prechter, he actually, the 2009 bottom, like when it was happening, he said, yeah, this is a huge bottom in stocks. So since then, I don't know what his view on, if he's maintained this deflationary view, but like these types of predictions, it becomes the brand for these people. And so that's their brand, and they're always going to stick with it. They're never going to change. And if you think about it, I mean, if gold is really, if you look at, if gold is really going to go to 900, the way it would happen would be, you have a really strong economy with strong real interest rates. And gold would crash because it would be at a 1980 level where it went parabolic.
Yeah.
Gold went from 35 to almost 900. So it made this huge move. It made a vertical move, and so that's why it crashed after that. And I mean, I don't know what was the percent. What was the percent decline there?
Yeah.
What was it, like 50% or 60%? And so the gold hasn't gone up enough where it's going to have that type of a crash move. So I mean, in fundamentally the way it would I mean, it's a joke. I'm sure people are probably laughing. We're going to have a strong economy and there's going to be positive real interest rates. Like that's just totally unrealistic. I mean, I think the bearish case for gold right now is you can say, like, technically it made this lower high. If you're looking at the monthly chart, yeah, if you're looking at the monthly chart, you can say, well, it made this monthly high, and that had a couple of really bad candles. But I mean, the candle this month, it'll be interesting to see where gold closes. If it doesn't tank over the next couple of trading days, it has the look of a potential bullish hammer, although it's not that strong because it's only following a couple of days of a downtrend. But I mean, if that's really I mean, technically you could say, maybe gold can come down to 1565, the 50% retracement, if we're going to have some kind of a severe decline in everything. I think, I'm not saying I agree with that, but I'm saying if I had to make a bearish case for gold, that's what I would say. Like, it's going to lose. Like, if you draw an uptrend from the what is it, the 2021 low? If you draw an uptrend line and gold has a hard break below the trend line, maybe, and if we have this huge selling in everything, maybe gold could come down to 1565, the 50% retracement from the 2016 low. I mean, that to me would be the bearish case, but there's not. Aside from that, I really don't see that much merit, because the worst thing for gold is the economy is getting stronger, the stock market is breaking out, and real interest rates are able to rise significantly. I mean, one reason why gold did really poorly in 2012 to 2013, the stock market, after being in a secular bear market, was starting a secular bull, and it broke out of a 13-year. It had a 13-year base. So
Exactly.
And if you look at, like, even in 2011, if you look at the CAPE ratio, I don't know if you have that on your charts, but I was playing around with some data and creating like an expected returns calculation. I mean, I can share my screen. I know we had trouble with that last time, but if you look at the CAPE ratio, you can see that in 2009 it was pretty low. Like, I want to say it was like 12 or 13, and then in 2011, I want to say it was like 17. When we had, when the stock market corrected in 2011, it had that 20% decline. Like, I think at the low there, it was around 17, 18, right when gold peaked. So, and then you can see, the stock market made a huge multi-decade breakout there.
Right here.
And the same thing happened in 1982, right after gold peaked. Gold had the blow off in 80. Interest rates. When did interest rates peak? 1981. Commodities, did they peak in 1981? So then a year later, you had a massive breakout in the stock market. So, and if you go back to the 40s and 50s, I think the commodities peaked in 1951. The stock market did have a breakout, I want to say 1950.
Yeah, exactly. Right here, somewhere here.
1950. So the three major breakouts in stocks happened right around the time gold and commodities peaked. And so it's the opposite. It's the opposite this time around. And I mean, that's happened historically. I mean, gold had a huge breakout in 1971 and then 2005 from the 20-year downtrend line. And so now we're setting up where it's setting up to have a significant breakout, 11-year, 12-year breakout, if it doesn't happen this year, of the cup and handle pattern. And stocks are going into a secular bear. And so that's, I mean, yeah, you're looking at, gold against the S&P. I mean, this is a very significant ratio, because gold cannot, if you look at gold's best moves historically, it happened when stock market was in a secular bear. And so that's been the problem the last 5 or 6 years. Yeah, gold has gone up. Gold stocks have gone up. They haven't really had a bull market because too much money has been flowing into stocks because they've still been in a secular bull. So now we're we're at the point where we're going to figure that out. We're going to answer that in the next 6 months, probably.
Yeah.
Are we in a new, it's going to be really important, because if we're not going into a secular bear market, then the stock market over the coming months should be able to recover and rebound and then make a new high. Now, if it doesn't, and it has a weak bear market rally, which I think it's happening right now, we've started this bear market rally. If the stock market has a bear market rally and then it fades and rolls over, end of the summer, early fall, that's going to be a sign that the market is discounting recession. The market is starting to discount a real bear market. The Fed will probably have to stop hiking if they haven't already. And to me, that's when we'll see gold start to move towards its breakout and probably break out. So, I mean, the next couple months could be a little tricky. People could get they could have the wrong reaction, because we could see a bear market rally for a couple months in the stock market. And so we'll see, we'll see what happens with gold. Gold will probably go sideways. Maybe there could be a little bit more selling if the Fed's able to hike a little bit more. But that to me is the catalyst. It's the stock market, the bear market rally that were likely started last Friday, that's going to fade. And when that fades and rolls over, the rate of inflation is coming down. Then the Fed will absolutely have to stop hiking rates. And then if that happens, then all the talk is not going to be about inflation. It's going to be about growth, recession. People are losing money, the economy's weak, and then that's going to allow gold to move towards that huge breakout.
Well, yeah, I think that makes so much sense. It's like in 2019 there, nobody I don't like seeing these huge inflation prints, because it's kind of telling me that when everybody's talking about it, it's time for something else, right? Like when gold broke out in 2019, I don't even remember what the inflation rate was back then. It was super low, right? Like nobody was thinking about that. So yeah, that would be kind of welcome, this type of
well, it's interesting because in the last 6 years, gold has actually done, if you look at the last 6 years, I know I'm talking so fast as you're trying to pull things up, but if you look at the last 6 years and you look at, if you look at gold and the CRB and the rate of inflation, gold and even silver as well, they did not do as well. Like, remember when they peaked in 2016? Like, they peaked in August, but in 2017, you had other commodities did well in 2017, whereas gold didn't really do anything. I mean, you had the weak dollar, but you can see the rate of inflation. So that happened in 2016, and the same thing happened in 2018. So 2017, and then into 2018, when the Fed was hiking, inflation expectations were rising a little bit, commodity prices were rising a little bit, gold and silver were doing nothing. But then when inflation peaked in the summer of 2018, the Fed had to stop hiking, and that's when gold and silver bottomed. And we could be seeing, we could see something similar. If it hasn't happened already, it happens in the next couple months. The rate of inflation peaks, and that will allow the Fed to stop hiking. And if that is accompanied by growth plummeting towards zero, that's an environment where gold, especially, and silver will follow, where they will start to perform better than everything. So I mean, that's what it's easy to forget that gold is counter-cyclical. Like, it's going to do its best when the economy and stock market are not performing well.
Yeah. It's like it's pricing in. I always like saying it's pricing in the incoming monetary imbalances that they'll have to do, right? It knows ahead of time, okay, this is going bad. They'll do some easing. So it starts exploding upwards when people say, I don't understand, there's no inflation, or but actually it's actually paving the way for the inflows of future inflation, I guess there.
Yeah, and I mean, I mean, it is curious in the last 18 months or so how gold and silver did not perform better, but at least market expectations, like the real tips yield, market expectations of real interest rates, for the most part, bottomed like a year ago in early 2021. I know it kind of sounds ridiculous because inflation has been rising significantly, but market expectations of real interest rates bottomed like a year ago. And also at the same time, I mean, we haven't really had stagflation yet. I mean, we're obviously looking back, maybe it started last quarter or it's starting right now. But, last year, for example, yeah, you had high inflation. Inflation was rising, but you still had growth. You had a lot of growth. The stock market was still growing, still rising. And in the 70s, you didn't have that. I mean, you had stagflation where gold was ripping higher, when inflation was rising and unemployment was rising and you had real stagflation. I think we're getting into, or we're entering into, a period of stagflation now where inflation is going to come down, but you can still see 3, 4, 5% inflation, but a recession. And so that's stagflation. Like, that's real stagflation. And then of course that's accompanied by the stock market is trending lower. And then the Fed, they're really in trouble. Like, even if inflation is just 3 or 4% and you have a recession, I mean, they're really in trouble. What are they going to do? Of course, they have to say, well, inflation has come down. We're going to have to print money again. So I think when that realization happens, like, that's going to coincide with gold, like, breaking above 2,100 and having this massive breakout.
Well, it's me. What always fascinates me is when I look at those ratio charts that fluctuate up and down. Let's say the gold to SPX. So even if the gold to SPX ratio has practically reset to, let's say, 2000 or 1970s or 2011, where it's like at the low range, but the nominal price of gold is that much higher. It's that relative strength, like with the ratio resetting of the gold to SPX, you'd imagine gold to be much lower. But then when you take a step back, say, man, it's still like 1800. It's like it's carved in a higher low, even while the reset in capital flows from gold to SPX has practically fully reset, like to historical. I'll just pop it back up, guys. So that's why it always it impresses me that while these ratios reset, I kind of see these ratios as fuel for the next rally up. So guys, look here, I'll just reset this chart we had. So this is gold to SPX right here. So even if we're back at these levels, that we're back at the 1970s level, the gold to SPX ratio, we're not quite at the extent of the dot-com bubble where U.S. equities like demolished gold. But look at that, guys. Here, gold was $100. Then it was right here was 300 in the 2000s. That's silver chart, of course. But now in gold's up at 1800. So I'm just imagining when this ratio, if it breaks out to the upside, like Jesus, it goes in line with the gold hitting, I don't know, wherever it's going to go, right? 25, 26, 3000, right?
Yeah, I mean, if you look at a lot of these data points, and if you look at, I know that chart, it doesn't go back before 1950, but if you look at,
it does.
There you can see some. Yeah, that's great. But yeah, you can see if you look at 150 years, you can see like gold divided by the S&P getting to 4. Like, historically over 150 years, like that's a real level that it's peaked at a handful of times. And so if you look at, I mean, what's the S&P trading at now? 4,000 or 38? Like, let's just say 4,000. Even if the S&P goes down, like, let's just say 30% off its high, what would that be? 3,000. I mean, 3,000 times 4, that's 12,000 for gold. So, and if you look at the monetary base and you look at the percentage of how much the gold is backing of the monetary base, like in 2008, that got to almost 30%. Like it was really close to 30%. And right now it's backing like, I think it's backing about 6% or maybe 5%. So if you look at that, and by the way, in 1980 and in the 1930s, that backed 100% of the monetary base. Like to back 100% of the monetary base, gold would have to be like 50. It would have to be like $50,000. So I completely agree with you. I mean, if you look at gold divided by these various data series that go back 100 years or 150 years or 130 years, they easily project potential for gold to get to $20,000, $30,000, $50,000. So and again, gold and again, the S&P is probably just starting a secular bear market. I mean, we're going to know the answer for sure in the next 3 or 6 months, but it's starting a secular bear. That's going to coincide with gold going into a secular bull. And, gold can go up, I mean, tenfold during that period. Like that's not a stretch. So when it starts, that's what it's going to start with. It's really going to start in earnest when gold breaks out of the cup and handle. And it's really going to be an explosive move. So, yeah, I'm pretty confident that when gold breaks out, it's going to 3,000 is the measured upside target. If you do a percent target, which is also called the log target, that comes in 3,700 to 4,100, depending on how you measure it. And so, I mean, it's just a question of timing. Maybe I'll be a year or two too early, but I think the breakout. I think the breaking to a new all-time high, like I think it's going to happen before the end of the year. I mean, if you put a gun to my head, I would say, sometime in I'd say like 6 to 9 months. I think that's the window. But yeah, you're showing the measured upside target there. But if you do a percent, can you do a log target?
That is the log move. But I'll do it with my other tool. So right here, you're measuring it, what, 70%? Is that where you're measuring it all the way to the neckline here or higher?
Well, it depends on if you're using the 2019 or the 2011 high or the 2020 high. So that's why I get 3,700 to 4,100.
Well, 70% move, yeah, 3,000, yeah, 3,000, 3,100.
But the log target is 100% of the move. So if the high is like if it's 2,000 to 1,000, then you get a.
Got it.
Yeah, then you get a doubling. So 4,000 would be the target.
Yeah.
But yeah, I mean you can see, and I looked at historically cup and handle patterns. Like there's not that many. They hit the measured upside target, and then 6 to 12 months after that, they hit the log target. So, and they even go all of them, they go well beyond the log target.
Well,
so this is just a question of timing. When gold when it breaks above 2,100 or 2,050, that's when it's going to really accelerate, and there's huge upside. And again, it's just a question of timing. The move could happen in like I think it's going to happen in the next 6 to 9 months, but maybe I'm wrong and it happens in 18 months. But that's all this analysis, you can see there's historical analysis that goes into this. There's a lot of macro analysis. There's intermarket analysis. So it's a lot more than just a cup and handle pattern, but everything is set up for gold to make this move. And I think silver has obviously been really weak relative to gold, but I think silver, when it's just going to follow gold. It's going to lag, but it's going to follow. And I think when gold breaks 2,100, I think after that point, that's when silver will really start to outperform gold.
And we'll get a drop in the gold to silver ratio at the same time. It's like I have a feeling the gold to silver ratio is just waiting to make sure that there's no market liquidity crash, right? That's what I've noticed recently. Like everybody sells silver and gold goes down, but a little bit less during like GFC or March Madness 2020 type crashes. And I think as soon as the market realizes that we're not heading into, or the probabilities of having a liquidity event are dissipating, that's when the DXY gets sold off, the VIX goes down, the gold silver ratio drops, and then silver starts outperforming. And it's probably going to happen, like you say, when gold decides to make a run above 2100. That means the coast is clear. And because look, there's not that much time left. Like I like looking at the 3-year moving average because it was super meaningful in the previous like bull run. And there's not that many candles left for it like to to stay above that inclining 3-year moving average. Because if it decides to go 18 months sideways, it's like it's not going to look great, because now it's going to start closing below that 3-year moving average. It could happen, but it's like I have a feeling that if we're in a true bull run, we shouldn't be closing below that 3-year moving average there, like by any means there.
Yeah, I think that it's pretty close to the 40-month moving average, which is my long-term moving average that I use for. Yeah, pull that up. You can see it's really similar. It's and you can see, even if you just go back like 40 years,
yeah,
you can see how it's been a great indicator. Like, yeah, even there in the 80s and 90s, you can see that we were, 1999, we rallied up to it, failed a couple times, and then the bull market really started when it went above. And then of course the 2008 bottom. So yeah, that's what I'm using. But one thing we have to be careful of is we don't want to get faked out. If the market closes below that, like it could be a month or two away from like a real important bottom. Like if we get a spike low, if we get a hard sell-off in the next couple months, like I said, 1565 or, maybe somewhere in the 1600s. Like if we get, because I think it's like at 1700, the 40-month is. Like if we get a spike low below that for just a month or two, we don't want to get faked out for two reasons. Because number one, if you get a spike low, you can get a V rebound like you had after the 2008 bottom.
Yeah.
Or the 2016 bottom, where you can get a really strong move in the next like 3 to 6 months coming off the bottom.
True.
And at the same time, like if we're looking back in this, like let's say it closes below the 40-month for a month or two, but then it does what we think it's going to do. It goes back up, it breaks out. Then when we're looking back at this, someone will say, "Oh, well, look at the 40-month moving average. I mean, yeah, it went below it for a month, but that doesn't, it barely happened. That didn't last long." So
That's why I zoom out to my 8-year moving average. Yeah. Well,
and it's also why understanding like things like sentiment in the macro and intermarket analysis is really important, because you can get so many false moves in gold and silver, and so you have to be careful of getting you capitulate at the bottom or right before the bottom. I mean, it on all time frames, as you know, gold and silver, it has a habit of making many false moves.
Especially here, what fascinates me is when it was total chaos in March of 2020. If I put that on, you see that's the wick, but if I put that on a line chart and just a monthly candle, look at that, you can't even tell there was a sell-off. It's still a beautiful uptrend, and it looked dire. I was like semi panicking in March of 2020. I saw gold price like plummeting. I said, Jesus, what the hell's happening? But if you take a breather, even on the quarterly chart, the March 20, look at that 80, look at that on the GFC crisis. If I put on the line chart, just on the quarterly, you cannot even see there's a GFC crisis. Like, tell me where the GFC crisis is. It's not even deeper than it was at the other pullbacks, barely.
Yeah, and that's why even if we, in this scenario, even if we, let's say gold goes down to, I don't know, 1650 or 1600, like intra-quarter, it's not going to close down. Like what if it could trade down to 1600 or 1650, but then it closes the quarter well above that. You wouldn't even see it. Like where's the close there for the last what's that support closing level? If we just come to the 21 low, where was that at? Oh, it's like 1700. So, we'll see if, if gold, whatever, if it, again, yeah, my example would be, what if it has this hard sell-off for like a month or two, but it's into a bottom, it comes down to, say 1620. I'm just picking random numbers, or 1600. Yeah, you'd see that on the daily and weekly, but then you look at the quarterly chart, it's like, oh, well, it didn't close below 1700. Nothing really happened. It just
Yeah.
had a bit of a sell-off.
Could just be a wick. That's why, especially with gold, like this is not Bitcoin where stuff's moving crazy fast. For me, like you need to look at least at the monthly chart for gold to reduce noise. Quarterly, I think it's pretty good also. And look at that. There's not many. This is 6 month candle. There's not many red candles. Once gold gets trending, it doesn't look. It doesn't do a lot of 6 month candle closes red, right? It does here 4 in a row, one quarter, and then it goes. It's a soup. I think like gold, it's easier to sabotage it, like because you're looking at intra daily or the folks looking at daily time frame. They're just waiting to sabotage your gold trade because gold, anybody could have loaded up here so clear in June of 2019. You could have loaded the boat, and I'm sure a lot of people, they sabotaged their trade along the way, right? In out, in out. There's like, but me, it's when
And
I
that
see
was
this
and
break.
that was the and that was the Fed. I mean, I think it was May 2019 when the Fed basically said, "Oh, we're going to cut rates." So, and that happened with the 2007 breakout too. So, I think that's why, looking at Fed policy at the same time, you have two things that are coming. You have number one, when they have to stop hiking, that's going to be good for gold. And then whenever they ease, depending on how they ease, that's going to be really good for gold. Like if they actually cut rates, um, depending, because I think they're going to hike the next two meetings. So at the end of July, they'll be at 2%. Like that's going to give them room to later in the year, early next year, if they want to cut, and then the government will be talking about fiscal stimulus. So and that's going to align with gold breaking out. So,
Yeah.
yeah, it's also important to look at the macro like that and align that with your charts because I remember that 2019 in May, even the stocks were just doing nothing and the mood at the conferences was really depressed. And suddenly a week later, the Fed basically told the market they're going to cut rates and everything just started moving up. And then when they did cut rates, gold had that huge breakout. That was a 6-year breakout above 1375.
I think we're so
So
close, Jordan. Look, I don't know. I looked at these. This is like the 30-year yield divided by the 10. And I'm not quite sure what they mean, but honestly, every time the market's priced in like a reversal for this, the Fed, like it's kind of like what you said, they're going ahead with like their planned rate hikes, but that's it. And it leads within, I calculated within 1 to 5 months after this starts turning up, if this actually like starts really turning up and we have a new uptrend, look, it's game over for rate hikes. Like every single time this has bottomed and turned up, it front led the Fed doing a pivot every time.
sorry to interrupt. What you have here, this is an excellent chart, and this is what I love about gold and macro analysis. Like you can put all these things on these charts and look at what's going on, and so you're looking at a yield spread, the 10 and the 30 basically.
Yeah.
The spread between the 10 and the 30, and then you have the Fed funds rate, and you can see what happens. Like this is why steepening, and people say when are rising, when these spreads steepen or they start rising, it's bullish for gold. And you can see, look what happens when they start rising. Usually the Fed stops and they have to start cutting soon. So that's beautiful what you've shown here. And also, yeah, I mean, I'm looking at the 10-year yield as well, because the 10-year yield, if you just put the 10-year yield on there, usually the 10-year yield will lead. I mean, it will start to turn lower like before they do the last hike.
I
And
care.
so is that you'd have to put up like, so that's a monthly. You'd have to put up like a daily to see it because it hasn't come down that much.
Got it.
But you can see there how it's come down a little bit.
That's turning. It's starting to turn.
in the last couple of months, it's come down from 3.12% to I think around 2.7%. I don't know what it's at today. I think it might have rallied a bit yesterday, but that's one thing to look for. Like if we see the 10-year yield fall to the mid twos and then the low twos, like that's it. The Fed's going to have to stop. So that to me right now is like one of my most important leading indicators.
I'm going to put an alert on it not to miss it when it goes down. But you know what? It's so weird because sometimes I have fun trying to understand everything, but then at the end of the day, I just look at the gold price because gold, it does all this work for us essentially, right? It looks at the yields, it does everything.
Yeah, but going back to that last chart you had, I mean that's just great stuff. When you can overlay all these things on charts, and then it can help you learn macro analysis with respect to gold. You can look at, okay, here's the rate of inflation, here's bond yields, here's the yield spread, here's what gold did, and that's informed my thinking a lot, which I'll restate, which is, I think we're going to see bond yields are going to come down. The economy is going to continue to weaken. And again, if you see the 10-year trading in the low twos, that's probably going to coincide with news about, recession. And you get that type of news, you get less news about inflation, then the Fed's going to have to stop hiking, then they're going to talk about cutting. And so that, then the yield curves are going to start steepening when they start cutting, and that's when gold really moves. And so it's all related. And at the same time, gold, you can look at the 10-year yield and gold against the S&P. I mean, it's different in every cycle, but gold against the S&P is also our leading indicator, because that should start to strengthen as the stock market rolls over again after this bear market rally. And you can see that the gold against the S&P, that's above the 200-day moving average right now. Like it's a good distance above it. So I think we're going to have a bear market rally in the S&P. So that ratio will probably soften a bit over the next month or two. It'll probably test the 200-day. But again, if I'm right about a secular bear and a recession coming, then the stock market will roll over at the end of the summer. And, that ratio that's going to lead the gold price, because that's what happened in the 2000 cycle. And when they have to, when they stop hiking, it's going to move up considerably.
Well, yeah. So I'm keeping an eye. The thing is, that thing with the gold is because when I saw it break out in 2019 and I got all jittery and all happy, but honestly, this and I think it's one of your comments that until the gold can break out versus SPX, everything else other than gold is going to suffer. Here I have the silver chart. It's not going to do a new high until this breaks out, until gold breaks out versus SPX, and USD CAD or the miners. All those charts, they look like the ratio of gold to SPX. So like right now, this is like just accumulation time, I guess, there until this really breaks out.
Yes. Yeah, I mean, I thought, going back to the end of 2015 and then 2018, I thought the S&P had to, it really, I was wrong, because my thinking was, the stock market's going to go into a bear, gold's going to go up, but the stock market has to go into a bear for gold to go up. And so I was wrong about that, because if you look at the last 5-6 years, gold has gone up, gold stocks have gone up, but the stock market has still gone up more. And so that's really the key shift that I'm expecting here for the balance of this year is, the market and big investors, they realize, okay, the stock market is going into a secular bear. Of course, the Fed will have to get easy again after they do these next couple hikes. But yeah, that's going to be, in my view, the catalyst for gold really taking off. And then, if it's breaking out of this cup and handle, like there's no resistance when it breaks above 2100. It's going to be free and clear. And then, I mean, silver's going to follow. And silver's just gold, it's gold on steroids with a lag.
Jesus,
It's just
man.
going to take, yeah, it's just going to take more time than the silver bulls think. But I mean, it'll be fine. It's going to follow gold and it'll be fine.
Totally agree. Man, Jordan, I don't want to take too much more of your time there, but man, we're still early. It's crazy. It's like it's just we're still, yeah, it's super early, man. It's crazy. It's hard to wrap my head around it. Every time, like, it's like my brain always, I think light years ahead, I have these roadmaps, but the market's it just takes more time to play out than I always anticipate.
Yeah, I mean, it takes more, these things, they take more time than you expect for them to play out. But then when they happen at a rate and an upside that's even, much less than you were anticipating.
I know. It's like huge bases, and then in 1 month, what? I wait. That's a 6-year base, and I get 1 month move. Yeah, but this is probably going to be longer than a few months there. But yeah, I can't wait for it to happen. But until then, just keep an eye on those breakout lines and monitor the situation as it unfolds.
Absolutely, yeah. Watch the bond market, watch gold against the S&P.
Jordan, it was great talking to you. You want to tell folks where they should find you?
thedailygold.com. I have a lot of free info there. So take a look at all the stuff I've posted.
All right. All right, guys, follow Jordan, go to his website, and hopefully we get to catch up in sometime in the near future, Jordan.
Absolutely. Yeah. My pleasure. Thanks so much for having me on, Patrick.
All right, Jordan. Take care.